Question 1. Comparative studies suggest that a proactive approach to premium auditing significantly enhances accuracy and fairness. In a scenario where a client reports a substantial shift in their primary business operations during the audit period, which of the following audit approaches best aligns with premium audit best practices and regulatory expectations for risk assessment? Option A. Focus the audit solely on the most recent financial statements provided by the client, assuming these reflect the current operational reality. Option B. Accept the client's self-reported figures for the new operational focus without independent verification, assuming the client has accurately reflected the changes. Option C. Conduct a comprehensive risk assessment by reviewing the client's provided documentation, cross-referencing with prior audit findings, and performing targeted inquiries and verification to confirm the nature and extent of operational changes. Option D. Rely exclusively on publicly available industry data for the client's reported new operations to estimate the premium exposure, without direct engagement with the client's specific records. The correct answer is C. Conduct a comprehensive risk assessment by reviewing the client's provided documentation, cross-referencing with prior audit findings, and performing targeted inquiries and verification to confirm the nature and extent of operational changes. Explanation. Scenario analysis. This scenario presents a common challenge in premium auditing, where a client's operational changes significantly impact their exposure. The auditor must balance the need for accurate premium calculation with the client's desire to minimize perceived overpayment, all while adhering to regulatory requirements and the insurer's policy terms. The challenge lies in interpreting the client's provided information, assessing its validity, and determining the appropriate audit scope and methodology without compromising the integrity of the audit or the insurer's financial position. Professional judgment is crucial in distinguishing between genuine operational shifts and attempts to misrepresent exposure. Correct approach analysis. The correct approach involves a comprehensive risk assessment to identify areas of potential misstatement or underreporting. This begins with a thorough review of the client's provided documentation, cross-referencing it with prior audit findings and industry benchmarks. The auditor should then conduct targeted inquiries and, if necessary, on-site verification to confirm the nature and extent of the operational changes. This systematic process ensures that the audit focuses resources on areas with the highest risk of premium leakage or overpayment, leading to a more accurate and defensible premium calculation. This aligns with the principles of sound auditing practice, emphasizing due diligence and professional skepticism, which are implicitly required by regulatory frameworks governing insurance and auditing, such as those overseen by bodies like the NAIC in the U.S. Promoting fair and accurate premium assessment. Incorrect approaches analysis. Accepting the client's self-reported figures without independent verification represents a failure to exercise professional skepticism and due diligence. This approach risks understating the actual exposure, leading to premium shortfalls for the insurer and potential noncompliance with policy terms. It also fails to identify potential fraud or unintentional errors in the client's reporting, focusing solely on the most recent period's reported figures without considering historical trends or the nature of the operational changes, ignores potential shifts in exposure that may not be immediately apparent in a single reporting period. This can lead to an inaccurate representation of the overall risk profile. Relying exclusively on external data sources without validating them against the client's specific operations is also problematic. While external data can provide context, it may not accurately reflect the unique circumstances of the insured entity, leading to an audit that is not tailored to the actual risk. Professional reasoning. Professionals in premium auditing should adopt a risk-based approach. This involves 1. Understanding the client's business and operations thoroughly. 2. Reviewing historical audit data and identifying trends or anomalies. 3. Analyzing current financial and operational information provided by the client. 4. Identifying areas of high risk for misstatement or noncompliance. 5. Developing an audit plan that targets these high-risk areas with appropriate verification procedures. 6. Documenting all findings and the rationale for audit conclusions. This structured approach ensures that audits are efficient, effective, and compliant with regulatory expectations for accurate premium determination. Question 2. The audit findings indicate that a premium auditor has been assigned to conduct an audit for a business owned by a close personal friend. The auditor has a history of performing audits for this business and has a good working relationship with the owner, but the personal friendship has recently deepened significantly. The auditor is concerned that this personal relationship might unconsciously influence their judgment regarding the classification of payroll or the assessment of exposures, potentially leading to an inaccurate premium calculation. What is the most ethically and legally sound approach for the premium auditor to take in this situation? Option A. Inform the insured business owner that the personal relationship might create a perceived conflict and ask if they would prefer a different auditor be assigned. Option B. Immediately disclose the deepening personal relationship to their audit supervisor and request to be reassigned to a different audit. Option C. Continue with the audit, but exclude any specific discussions about the premium calculation with the insured until the final report is drafted. Option D. Proceed with the audit as assigned, exercising extra diligence to remain objective and ensuring all documentation supports the findings. The correct answer is D. Proceed with the audit as assigned, exercising extra diligence to remain objective and ensuring all documentation supports the findings. Explanation. The audit findings indicate a potential conflict of interest that requires careful navigation due to the associate in premium auditing. APA exam's emphasis on legal and ethical considerations. The challenge lies in balancing the auditor's duty to accurately assess premium based on the insured's operations with the personal relationship that could influence objective judgment. Adherence to professional standards and regulatory guidelines is paramount to maintaining the integrity of the audit process and the trust placed in premium auditors. The correct approach involves transparently disclosing the personal relationship to the audit supervisor and requesting reassignment of the audit. This upholds the ethical principle of objectivity and avoids even the appearance of impropriety. Regulatory frameworks for insurance professionals, including those implicitly guiding APA candidates, mandate that auditors act with integrity and avoid conflicts of interest. Disclosing the relationship and recusing oneself from the audit demonstrates a commitment to these principles, ensuring that the premium assessment is conducted without bias and in full compliance with applicable laws and guidelines. An incorrect approach would be to proceed with the audit while attempting to remain impartial. This fails to acknowledge the inherent risk of unconscious bias and violates the ethical obligation to avoid situations that could compromise professional judgment. The appearance of bias, even if unintentional, can erode confidence in the audit process and lead to regulatory scrutiny. Another incorrect approach is to downplay the significance of the personal relationship to the insured and continue with the audit. This demonstrates a lack of integrity and a disregard for ethical standards. It suggests a willingness to prioritize personal convenience or relationships over professional duty and regulatory compliance. A further incorrect approach would be to resign from the audit without proper disclosure or handover. While it removes the individual from the conflict, it fails to fulfill the auditor's responsibility to the employer and the insured. Proper procedure requires a transparent and managed transition to ensure the audit is completed accurately and efficiently. The professional decision-making process in such situations should involve a clear assessment of potential conflicts of interest against established ethical codes and regulatory requirements. When a conflict is identified, the immediate step should be to consult internal policies and supervisors. Transparency, objectivity, and a commitment to the integrity of the audit process should guide the decision, prioritizing the avoidance of bias and adherence to professional standards above all else. Question 3. Investigation of an insured's income statement for premium audit purposes reveals a significant increase in gross sales compared to the prior year. The insured attributes this solely to increased market demand and has provided a summary report of total sales. What is the most appropriate approach for the premium auditor to take in analyzing this information to ensure accurate premium calculation? Option A. Inquire further into the nature of the increased sales, examining supporting documentation for revenue recognition, and the classification of sales within the insured's business operations to ensure alignment with policy coverage. Option B. Accept the insured's summary report of total sales as accurate and proceed with premium calculation based on this figure. Option C. Focus the analysis on expense accounts that might offset the increased sales, as these could potentially reduce the overall premium. Option D. Rely on the prior year's sales figures as a benchmark and adjust the current year's figures based on a general inflation rate. The correct answer is B. Accept the insured summary report of total sales as accurate and proceed with premium calculation based on this figure. Explanation. This scenario is professionally challenging because it requires the premium auditor to navigate the inherent tension between the insured's desire to present their financial performance favorably and the auditor's obligation to accurately reflect the company's operations for premium calculation. The auditor must exercise sound professional judgment to ensure that the income statement analysis is conducted in a manner that is both compliant with regulatory requirements and ethically sound, preventing misrepresentation that could lead to an inaccurate premium. The correct approach involves a thorough review of the income statement, focusing on the classification and valuation of revenue and expenses as they relate to the insured's business operations and the policy coverage. This includes scrutinizing significant revenue streams and expense categories for accuracy and completeness, ensuring they align with the audit agreement and the policy terms. This approach is correct because it directly supports the fundamental principle of premium auditing, to accurately determine the basis for premium calculation by verifying the financial data provided by the insured. Regulatory frameworks for premium auditing, such as those governing workers' compensation or general liability insurance in the U.S., mandate that auditors obtain sufficient, appropriate evidence to support their findings. This involves understanding the insured's business and how their income and expenses are generated and reported, ensuring that all relevant exposures are captured for premium calculation. Ethical guidelines also require auditors to be objective and independent, avoiding any actions that could be perceived as biased or that could lead to an unfair premium for either the insured or the insurer. An incorrect approach would be to solely rely on the insured's provided summary figures without independent verification or deeper inquiry into the underlying accounts. This fails to meet the auditor's responsibility to obtain sufficient audit evidence and could lead to material misstatements in the premium calculation. It also risks violating regulatory requirements that stipulate a certain level of due diligence and verification. Another incorrect approach would be to focus exclusively on expense items that appear to reduce the premium without a corresponding analysis of revenue generation, or vice versa. This selective focus ignores the holistic nature of income statement analysis for premium determination and can lead to an incomplete and inaccurate assessment of the insured's risk exposure. Ethically, this selective approach could be seen as an attempt to manipulate the premium outcome, undermining the auditor's integrity. The professional reasoning process for similar situations should involve a systematic approach. First, understanding the specific policy and audit agreement to identify the relevant premium basis and coverage. Second, planning the audit procedures based on this understanding, including the scope of income statement analysis. Third, executing the audit procedures, which involves gathering and evaluating evidence from the income statement and supporting documentation. Fourth, critically assessing the findings, identifying any discrepancies or areas requiring further investigation, and making informed judgments based on professional standards and regulatory requirements. Finally, documenting the audit process and conclusions thoroughly to support the premium determination. Question 4. Governance review demonstrates that a multi-state employer has allocated its payroll for premium calculation purposes based on the state in which each employee's primary office is located, without a detailed analysis of the specific duties performed by employees who travel or work remotely across state lines. Which approach best ensures compliance with the associated premium auditing, a PA exam's regulatory framework for accurate payroll allocation and reporting? Option A. Allocate all payroll to the state where the majority of the company's operations are based, assuming this reflects the primary risk exposure. Option B. Apply a single, overarching classification code that is commonly used for similar roles across all states where the company operates. Option C. Accept the insured's current payroll allocation method as it is based on their internal administrative structure. Option D. Conduct a detailed review of each employee's job description and operational duties to determine the most appropriate state and classification code for their payroll, regardless of their primary office location, adhering to each state's specific rating rules. The correct answer is D. Conduct a detailed review of each employee's job description and operational duties to determine the most appropriate state and classification code for their payroll, regardless of their primary office location, adhering to each state's specific rating rules. Explanation. This scenario is professionally challenging because it requires a premium auditor to navigate the complexities of payroll allocation across different states, each with its own unique workers' compensation classification codes and reporting requirements. The auditor must ensure that payroll is accurately assigned to the correct state and classification to prevent underpayment or overpayment of premiums, which can have significant financial implications for both the insured and the insurer. The challenge lies in interpreting the insured's operational structure and employee duties to align them with the specific regulatory definitions of each classification code within each state's jurisdiction. Careful judgment is required to avoid misclassification, which can lead to regulatory penalties and disputes. The correct approach involves meticulously reviewing the insured's payroll records and operational descriptions to determine the primary duties of each employee. This approach requires the auditor to cross-reference employee roles with the specific workers' compensation classification codes applicable in each state where the insured operates. The auditor must then allocate the payroll of each employee to the state and classification code that most accurately reflects their work activities, adhering strictly to the rules and definitions provided by each state's workers' compensation rating bureau or governing body. This ensures compliance with the principle of accurate premium calculation based on the actual risk exposure, as mandated by regulatory frameworks that require premiums to reflect the hazards of the work performed. An incorrect approach that involves simply allocating payroll based on the employee's physical location without considering the nature of their work activities is professionally unacceptable. This fails to comply with the fundamental principle of workers' compensation insurance, which is to rate based on the hazard of the employment, not just the location of the employee. This can lead to misclassification, where employees performing high-risk duties in one state might be classified under a low-risk code if their payroll is solely attributed to a state with a more favorable classification for that general location. Another incorrect approach, which is to rely solely on the insured's self-reported allocation without independent verification, is also professionally unacceptable. While the insured provides the initial data, the auditor's role is to independently verify the accuracy and compliance of this data with regulatory requirements. Over-reliance on the insured's reporting can perpetuate errors and omissions, leading to inaccurate premium calculations and potential noncompliance. A third incorrect approach, which is to apply a single, generic classification code across all states for similar job titles, ignores the jurisdictional specificity of workers' compensation regulations. Each state has its own set of classification codes and rules, and a code that accurately reflects the risk in one state may not do so in another. This approach disregards the regulatory mandate to adhere to the specific classification structure of each state, leading to potential misrepresentation of risk and inaccurate premium assessments. The professional decision-making process for similar situations should involve a systematic review of all available documentation, including payroll records, employee descriptions, and operational procedures. The auditor must then consult the relevant state-specific workers' compensation manuals and regulations to ensure accurate classification and allocation. When in doubt, seeking clarification from the relevant state rating bureau or the insurer's underwriting department is a crucial step. The ultimate goal is to ensure that the premium accurately reflects the risk exposure in accordance with all applicable laws and guidelines. Question 5. Benchmark analysis indicates that premium auditors often face time constraints. An auditor is reviewing a complex business operation and encounters a classification that is not immediately clear from the standard classification manual. The auditor has access to an internal company database that is updated quarterly, a colleague who has extensive experience in similar audits, and the latest edition of the relevant state's workers' compensation classification rules, which approach to researching the classification is most aligned with professional auditing standards and ethical obligations. Option A. Ask the insured for their preferred classification, as they are most familiar with their own operations. Option B. Accept the classification suggested by the experienced colleague, as their intuition is usually accurate. Option C. Rely on the internal company database, as it is updated quarterly and likely contains the most relevant information. Option D. Utilize the latest edition of the state's workers' compensation classification rules and consult internal subject matter experts if further clarification is needed. The correct answer is D. Utilize the latest edition of the state's workers' compensation classification rules and consult internal subject matter experts if further clarification is needed. Explanation. This scenario presents a professional challenge because the premium auditor is faced with conflicting pressures: the desire to complete the audit efficiently and the ethical obligation to ensure accurate classification, which directly impacts the insured's premium and the insurer's financial stability. The auditor must navigate the potential for misclassification due to incomplete information and the temptation to rely on readily available but potentially outdated or inaccurate resources. Careful judgment is required to balance efficiency with the fundamental principles of premium auditing. The correct approach involves proactively seeking out and utilizing authoritative, up-to-date resources for classification research, even if it requires additional time and effort. This aligns with the core ethical principles of integrity and due diligence expected of an associate in premium auditing. Specifically, referencing official classification manuals, state-specific regulatory bulletins, and consulting with internal subject matter experts ensures that the classification is based on current and accurate information, thereby upholding the accuracy of the premium calculation and fulfilling the auditor's professional responsibilities. This adherence to established guidelines and best practices is implicitly or explicitly required by the professional standards governing premium auditing. Relying solely on an outdated internal company database for classification research is professionally unacceptable. This approach fails to account for recent regulatory changes, industry updates, or evolving classification interpretations. It risks misclassifying the insured's operations, leading to an incorrect premium. This violates the principle of due diligence and could expose the insurer to financial loss or regulatory penalties. Accepting the insured's self-classification without independent verification, even if the insured appears knowledgeable, is also professionally unsound. While the insured's input is valuable, the auditor's role is to independently verify and apply the correct classifications based on the governing rules. This approach abdicates the auditor's responsibility and can lead to misclassification if the insured has misunderstood or misrepresented their operations. Consulting with a colleague who has a good feel for classifications without verifying their knowledge against authoritative sources is similarly problematic. While peer consultation can be beneficial, it should supplement, not replace, the use of official resources. Relying on anecdotal knowledge or informal opinions can perpetuate errors and does not provide the necessary objective basis for classification decisions. The professional decision-making process for similar situations should involve a systematic approach. 1. Identify the classification in question. 2. Consult the primary authoritative classification resources, e.g., NCCI Basic Manual, State-Specific Manuals. 3. If ambiguity exists, seek clarification from internal subject matter experts or regulatory bodies. 4. Document all research and the basis for the final classification decision. 5. Prioritize accuracy and compliance over expediency. Question 6. The review process indicates that a motor carrier has provided documentation suggesting they operate primarily as a local delivery service, transporting general merchandise within a 50-mile radius. However, during the audit, it is noted that a significant portion of their hauls involve transporting specialized equipment for construction projects, often requiring overnight stays and exceeding the 50-mile radius on return trips. Even if the initial delivery was local, the auditor must determine the most appropriate classification for premium calculation. Option A. Classify the carrier using a generalized mixed operations category without further investigation into the specific proportions and risks associated with each type of haul. Option B. Classify the carrier based on their actual operational scope, including the transportation of specialized equipment, the extended radii of operation, and the nature of the hauls, which indicates a broader risk profile than initially presented. Option C. Classify the carrier based on the type of equipment they own, assuming that specialized equipment implies a higher risk regardless of operational scope. Option D. Classify the carrier based on the majority of their hauls being local deliveries of general merchandise, as this represents their primary stated business. The correct answer is D. Classify the carrier based on the majority of their hauls being local deliveries of general merchandise, as this represents their primary stated business. Explanation. This scenario is professionally challenging because accurately classifying motor carriers is fundamental to correct premium calculation and compliance with regulatory requirements. Misclassification can lead to underpayment or overpayment of premiums, potentially resulting in financial penalties, regulatory scrutiny, and strained client relationships. The auditor must apply a nuanced understanding of the operational definitions of different motor carrier classifications, as defined by the relevant regulatory framework for the Associate in Premium Auditing, APA exam. The correct approach involves meticulously examining the carrier's actual operations, including the types of goods transported, the radius of operation, and the nature of the hauls, e.g., local, intermediate, long haul, interstate, intrastate. This detailed operational analysis ensures that the classification aligns with the established definitions, thereby accurately reflecting the risk profile and premium exposure. This aligns with the core principles of premium auditing, which mandate a thorough and accurate assessment of risk based on documented evidence and regulatory guidelines. An incorrect approach that relies solely on the carrier's self-reported classification without independent verification is professionally unacceptable. This fails to uphold the auditor's responsibility to ensure accuracy and compliance, potentially masking significant risk discrepancies. Another incorrect approach that focuses only on the type of equipment used, without considering the operational scope and cargo, is also flawed. Equipment is a factor, but operational characteristics are paramount in determining the correct classification under the regulatory framework. Finally, an approach that prioritizes expediency over accuracy, by applying a broad, generalized classification without detailed operational review, demonstrates a lack of due diligence and professional integrity, violating the foundational principles of premium auditing. Professionals should approach such situations by first understanding the specific definitions and criteria for motor carrier classifications within the governing regulatory framework. They must then gather comprehensive evidence of the carrier's operations, cross-referencing this evidence against the established definitions. When discrepancies arise, further investigation and clarification are necessary. Ethical considerations demand transparency and accuracy, ensuring that the premium accurately reflects the risk, benefiting both the insurer and the insured. Question 7. The performance metrics show a consistent trend of insureds questioning the final premium audit classification applied to their businesses, particularly concerning the distinction between clerical office duties and field operations. This suggests a potential disconnect between how insureds perceive their operations and how they are being categorized for premium calculation purposes. Which of the following premium audit approaches best addresses this recurring issue by ensuring accurate classification and fostering greater insured confidence? Option A. Conducting a detailed review of the insured's payroll records and job descriptions to identify the primary duties performed by employees, then matching these duties to the most specific and appropriate premium audit classification, and clearly documenting the rationale for the chosen classification in the audit report. Option B. Applying the broadest available premium audit classification that encompasses all reported activities, regardless of their primary nature, to simplify the audit process. Option C. Classifying all employee activities under the general office classification, unless the insured explicitly states that a significant portion of their workforce performs manual labor outside of an office setting. Option D. Accepting the insured's initial self-reported business description without further investigation, assuming their understanding of their operations is accurate for classification purposes. The correct answer is A. Conducting a detailed review of the insured's payroll records and job descriptions to identify the primary duties performed by employees, then matching these duties to the most specific and appropriate premium audit classification, and clearly documenting the rationale for the chosen classification in the audit report. Explanation. This scenario presents a common challenge in premium auditing, where the auditor must accurately classify the insured's operations to ensure the correct premium is charged. The challenge lies in interpreting the insured's description of their business activities against the established audit classifications. Misclassification can lead to underpayment or overpayment of premiums, impacting both the insurer's financial stability and the insured's operational costs. Careful judgment is required to ensure fairness and compliance with policy terms and regulatory guidelines. The correct approach involves a thorough review of the insured's actual operations, comparing them against the definitions and scope of the relevant premium audit classifications. This requires the auditor to go beyond the insured's initial self-reporting and gather evidence of how the business is conducted. The auditor must then apply the classification that most accurately reflects the predominant nature of the insured's business activities, adhering to the principles of premium auditing as outlined in relevant industry standards and regulatory guidance, which emphasize accuracy and fairness in premium determination. An incorrect approach would be to solely rely on the insured's stated business description without independent verification. This fails to acknowledge the auditor's responsibility to confirm the accuracy of the information provided, and could lead to a misclassification if the insured's description is incomplete or misleading. Another incorrect approach would be to select a classification based on convenience or the perceived ease of auditing, rather than on the actual operational activities. This compromises the integrity of the audit process and violates the principle of accurate premium determination. A further incorrect approach would be to apply a classification that is broader than the insured's actual operations, potentially leading to an inflated premium. This would be contrary to the objective of charging a premium that accurately reflects the risk exposure. Professionals should approach such situations by first understanding the policy's audit provisions and the applicable premium audit classifications. They should then gather comprehensive information about the insured's operations through documentation review, interviews, and site visits if necessary. The auditor must critically analyze this information, comparing it against the classification definitions. If ambiguity exists, the auditor should consult internal guidelines, subject matter experts, or relevant regulatory interpretations to make an informed and defensible decision. The ultimate goal is to ensure the premium accurately reflects the risk insured, in compliance with all applicable regulations and policy terms. Question 8. Assessment of a small manufacturing business reveals that, while their primary output is custom furniture, a significant portion of their revenue is generated from on-site installation services performed by their own employees at client locations. The premium auditor is presented with the insured's proposed classification, which solely reflects the furniture manufacturing code. What is the most appropriate course of action for the auditor to ensure accurate premium classification? Option A. Investigate the on-site installation operations to determine if a separate classification code is required or if the existing code adequately encompasses this activity, consulting relevant classification manuals and regulatory guidelines. Option B. Apply a general labor classification code to the installation services, as it is a common practice for service-related activities. Option C. Advise the insured to obtain a separate insurance policy for their installation services to avoid complicating the current audit. Option D. Accept the insured's proposed classification as it represents the primary business activity and is the most straightforward approach. The correct answer is A. Investigate the on-site installation operations to determine if a separate classification code is required or if the existing code adequately encompasses this activity, consulting relevant classification manuals and regulatory guidelines. Explanation: the assessment of accurate classifications in premium auditing is paramount to ensuring fair and compliant insurance practices. This scenario is professionally challenging because it requires the auditor to balance the insurer's need for accurate premium collection with the insured's expectation of correct coverage and fair pricing, all within the confines of established regulatory frameworks. Misclassification can lead to underpayment of premiums, exposing the insurer to financial risk, or overpayment, unfairly burdening the insured. The auditor must exercise keen judgment, relying on a thorough understanding of the business operations and the applicable classification codes. The correct approach involves a meticulous review of the insured's operations, comparing them against the definitions and guidelines of the relevant classification codes as defined by the governing regulatory body for premium auditing in the specified jurisdiction. This ensures that the premium accurately reflects the risk exposure. Specifically, the auditor must identify the primary and any secondary operations and assign the most appropriate classification code based on the predominant nature of the business. This aligns with the regulatory requirement to charge premiums commensurate with the risk, preventing adverse selection and maintaining the integrity of the insurance pool. Adherence to these classification rules is a fundamental ethical and regulatory obligation for premium auditors. An incorrect approach would be to rely solely on the insured's self-reported classification without independent verification. This fails to uphold the auditor's duty to ensure accuracy and compliance, potentially leading to significant premium discrepancies and regulatory noncompliance. Another incorrect approach is to apply a classification code that is broadly similar but not precisely defined for the specific operations, such as using a general clerical code for an operation that has specific risk-related duties. This demonstrates a lack of diligence and a failure to adhere to the detailed classification guidelines, which are designed to capture nuances in risk. Finally, prioritizing speed over accuracy by selecting the most convenient or easily justifiable classification, even if it doesn't perfectly match the operational reality, is a serious ethical lapse and a violation of regulatory expectations for thoroughness. Professionals should approach such situations by first understanding the insured's business operations in detail through documentation review and on-site observation. They should then consult the official classification manuals and any relevant regulatory interpretations or bulletins. If ambiguity exists, seeking clarification from the underwriter or a designated authority within the insurance company, or even the regulatory body if necessary, is the responsible course of action. The decision-making process should always prioritize accuracy, compliance with regulations, and fairness to both the insurer and the insured. Question 9. Upon reviewing the financial statements of a manufacturing client, a premium auditor notices that a significant portion of labor costs are categorized under a general administrative expense account rather than being allocated to specific production classifications. The auditor suspects this might be an attempt to misclassify payroll and reduce workers' compensation premiums. Which of the following represents the most appropriate best practice approach for the auditor to take in this situation? Option A. Immediately adjust the premium based on the assumption that all labor costs in the general administrative account are subject to the highest applicable manual rate, without further investigation or consultation with the insured. Option B. Request a detailed breakdown of the general administrative expense account from the insured, specifically seeking documentation that supports the allocation of these labor costs to non-production or clerical duties, and cross-reference this with the insured's operational descriptions and the governing classification manual. Option C. Accept the insured's categorization of these labor costs as general administrative expenses, assuming the insured's accounting practices are correct, and that the auditor's role is not to reclassify expenses, but merely to verify reported figures. Option D. Focus solely on the explicitly identified payroll accounts and disregard the general administrative expense account, as it is not directly labeled as payroll and therefore not within the scope of a standard payroll audit. The correct answer is B. Request a detailed breakdown of the general administrative expense account from the insured, specifically seeking documentation that supports the allocation of these labor costs to non-production or clerical duties, and cross-reference this with the insured's operational descriptions and the governing classification manual. Explanation. This scenario presents a professional challenge because the premium auditor must interpret financial statements to assess the accuracy of payroll classifications, which directly impacts the premium charged to the insured. The challenge lies in identifying potential misrepresentations or errors in how payroll expenses are categorized, especially when the insured's internal accounting practices may not align perfectly with insurance classification rules. The auditor's judgment is critical in distinguishing between genuine accounting differences and deliberate attempts to understate exposure. The correct approach involves a thorough examination of the insured's general ledger and supporting documentation, cross-referencing payroll expenses against the applicable workers' compensation classifications. This method aligns with the fundamental principles of premium auditing, which require verification of exposures as reported by the insured against actual operations. Regulatory frameworks, such as those governing insurance and auditing standards, mandate that auditors obtain sufficient appropriate evidence to support their conclusions. This includes scrutinizing financial records to ensure that all payroll subject to premium is accurately identified and classified according to the governing manual rules. Ethical considerations also demand an objective and diligent approach, ensuring fairness to both the insured and the insurer. An incorrect approach would be to solely rely on the insured's summary payroll reports without independent verification. This fails to meet the auditor's responsibility to conduct a thorough review and could lead to inaccurate premium calculations. It also bypasses the requirement for due diligence, potentially allowing for misclassification to go undetected, which is a violation of professional auditing standards. Another incorrect approach would be to accept the insured's explanations for any discrepancies without seeking corroborating evidence from the financial statements or other documentation. This demonstrates a lack of professional skepticism and an abdication of the auditor's duty to verify information. Could also be seen as a failure to adhere to the principle of obtaining sufficient appropriate audit evidence, as outlined in auditing guidelines. A further incorrect approach would be to make assumptions about the accuracy of the financial statements based on the insured's reputation or the length of their business operations. While reputation is a factor, it does not absolve the auditor from the responsibility of performing a detailed review of the financial data. This approach neglects the core function of an audit, which is to independently verify the reported information. The professional decision-making process for similar situations should involve a systematic review of the insured's financial records, a clear understanding of the applicable classification rules, and the application of professional skepticism. Auditors should always seek to corroborate information and document their findings thoroughly. When discrepancies arise, they should be investigated with supporting evidence, and any adjustments to premium should be clearly justified and communicated. Question 10. Process analysis reveals that a client, a small bakery, has insured a panel van under their commercial auto policy. The client's application states the van is used for local deliveries within a 10-mile radius. However, during the premium audit, the auditor observes the van parked at a distribution hub typically used for longer-haul logistics, and a review of dispatch records indicates frequent trips exceeding 50 miles to supply satellite retail locations. Based on this information, what is the most appropriate action for the premium auditor? Option A. Reclassify the panel van to a classification that reflects its actual operational use, which appears to involve longer-distance transportation, and adjust the premium accordingly. Option B. Maintain the current classification of the panel van as stated by the client, assuming the client's description of local deliveries is accurate for the majority of its use. Option C. Classify the panel van based solely on its physical appearance as a panel van, without further consideration of its operational radius or dispatch records. Option D. Reclassify the panel van to a classification representing the highest possible risk for a panel van, regardless of the specific evidence of its current operational use. The correct answer is A. Reclassify the panel van to a classification that reflects its actual operational use, which appears to involve longer-distance transportation, and adjust the premium accordingly. Explanation. Scenario analysis. This scenario presents a common challenge in premium auditing, where a client's reported vehicle usage and classification may not align with the actual operational reality. The auditor must exercise professional judgment to ensure accurate classification, which directly impacts premium calculation. Misclassification can lead to undercharging, resulting in potential loss for the insurer and regulatory scrutiny, or overcharging, leading to client dissatisfaction and potential disputes. The challenge lies in interpreting the nuances of vehicle usage against established classification guidelines without resorting to arbitrary decisions. Correct approach analysis. The correct approach involves a thorough review of the client's operational descriptions, supporting documentation, and direct observation or inquiry regarding the primary use of the vehicle. This aligns with the fundamental principles of premium auditing, which mandate accurate risk assessment based on factual information. Specifically, for commercial auto policies, the classification of a vehicle is determined by its primary use and the nature of the operations it supports. If a vehicle is described as primarily used for local deliveries, but is consistently observed or documented to be used for long-haul transportation, the auditor must reclassify it to reflect the higher risk associated with that usage. This adherence to the actual operational risk is paramount for regulatory compliance and fair premium assessment. Incorrect approaches analysis. Classifying the vehicle solely based on the client's initial description without further investigation fails to uphold the auditor's responsibility to verify information and assess the true risk. This approach risks misrepresenting the operational exposure and can lead to inaccurate premium calculations, potentially violating regulatory requirements for fair and equitable rating. Classifying the vehicle based on its appearance or general type without considering its specific operational use is also a failure. Vehicle types can be misleading. A van, for instance, can be used for local deliveries, tradesperson use, or even as a passenger vehicle, each carrying different risk profiles and requiring distinct classifications. Relying on superficial characteristics ignores the core principle of risk-based classification. Reclassifying the vehicle to the highest possible risk category without sufficient evidence of that usage is an overreach. While accuracy is crucial, arbitrary escalation of risk without factual basis can lead to unfair premium charges and damage the client relationship. This approach lacks the professional diligence required to justify such a change. Professional reasoning. Professionals should approach such situations by first understanding the policy's classification rules and the specific definitions of vehicle uses within the relevant regulatory framework. They should then gather all available evidence, including client statements, operational logs, and any physical inspection findings. A systematic comparison of this evidence against the established classification criteria is essential. If discrepancies exist, the auditor must document their findings and the rationale for any proposed reclassification, ensuring it is supported by objective evidence and aligns with regulatory guidelines. This process ensures fairness, accuracy, and compliance. Question 11. Performance analysis shows a significant increase in the insured's claims-to-premium ratio over the past audit period. The auditor has reviewed the insured's financial statements and noted a corresponding increase in the cost of goods sold. Which of the following represents the most appropriate approach for the premium auditor? Option A. Focus solely on the claims data and disregard the changes in the cost of goods sold, as premium audits are primarily concerned with loss experience. Option B. Investigate the increase in the cost of goods sold to determine if it is directly related to the types of operations that generate the claims, and if the increase reflects a genuine change in business operations or an attempt to misrepresent exposure. Option C. Immediately adjust the premium upwards based on the increased claims-to-premium ratio, assuming the insured is attempting to reduce their premium liability. Option D. Accept the insured's explanation that the increase in cost of goods sold is a general market fluctuation and does not require further investigation for premium adjustment purposes. The correct answer is B. Investigate the increase in the cost of goods sold to determine if it is directly related to the types of operations that generate the claims, and if the increase reflects a genuine change in business operations or an attempt to misrepresent exposure. Explanation. This scenario is professionally challenging because it requires an auditor to interpret financial data not just for accuracy, but also for its implications on the insured's operational health and the accuracy of premium calculations, all within the strict confines of regulatory expectations for premium auditing. The auditor must exercise sound professional judgment to discern whether observed financial trends are indicative of genuine business changes or potential misrepresentations that could impact premium. The correct approach involves a thorough review of the insured's financial statements and operational data to understand the drivers behind the observed ratio changes. This means investigating whether increases in expense ratios are due to legitimate business expansion, increased operational costs, or a change in the nature of the business. For example, if a significant increase in a particular expense category is noted, the auditor must seek supporting documentation and explanations from the insured to determine if this expense is directly related to the operations covered by the policy. This aligns with the regulatory framework's emphasis on accurate premium determination based on the actual exposure to risk. The auditor's duty is to ensure that the premium paid reflects the true risk profile of the insured, and this requires a deep dive into the underlying causes of financial fluctuations, not just superficial observation. An incorrect approach would be to solely focus on the numerical change in ratios without seeking underlying explanations. For instance, if an auditor notes a rise in a specific expense ratio and immediately assumes it's an attempt to reduce premium without investigating the insured's explanations or supporting documentation, this fails to uphold the principle of fair and accurate premium assessment. This approach risks penalizing the insured for legitimate business changes or overstating the risk if the expense is not truly indicative of increased exposure. Another incorrect approach would be to accept the insured's explanation at face value without independent verification or seeking corroborating evidence. This could lead to an inaccurate premium if the insured is intentionally misleading the auditor. The regulatory framework mandates due diligence and a reasonable basis for audit findings. Professionals should approach such situations by first understanding the context of the ratio changes within the insured's industry and business operation. They should then engage in open communication with the insured to gather explanations and supporting documentation. Finally, they must critically evaluate the provided information, cross-referencing it with other available data and their professional knowledge to form a well-supported conclusion regarding the impact on premium. Question 12. Implementation of a premium audit for a landscaping company reveals that while the primary business is grounds maintenance, a significant portion of their revenue is derived from installing new garden beds, which involves some light construction elements. The auditor must determine the most appropriate classification for the entire operation. Option A. Classify the operation by splitting the payroll between grounds maintenance and light construction classifications, even if the construction is incidental. Option B. Classify the operation based on the classification that carries the lowest premium rate, as this is most beneficial to the insured. Option C. Classify the entire operation under the most encompassing classification that covers both grounds maintenance and light construction, ensuring all exposures are accounted for. Option D. Classify the operation solely based on the insured's stated primary business of grounds maintenance, as this represents the majority of their reported revenue. Correct answer is C. Classify the entire operation under the most encompassing classification that covers both grounds maintenance and light construction, ensuring all exposures are accounted for. Explanation. The scenario presents a common challenge in premium auditing, accurately classifying a policy when the insured's operations are complex and potentially span multiple classifications. The premium auditor must exercise professional judgment, guided by regulatory frameworks and policy language, to ensure the correct premium is charged. Misclassification can lead to underpayment or overpayment of premiums, impacting both the insurer's financial stability and the insured's operational costs, and potentially violating regulatory requirements for fair premium assessment. The correct approach involves a thorough review of the insured's actual operations, comparing them against the descriptions and exclusions within the relevant insurance policy and the governing state's workers' compensation classification rules. This requires understanding the nuances of each classification code and how they apply to specific job duties. The auditor must then select the classification that most accurately reflects the predominant nature of the insured's business activities, adhering to the principle of classifying based on actual exposure. This aligns with regulatory mandates for accurate premium calculation and fair treatment of policyholders. An incorrect approach would be to solely rely on the insured's self-reported classification without independent verification. This fails to meet the auditor's responsibility to verify exposures and could lead to misclassification if the insured misunderstands their operations or intentionally misrepresents them. Another incorrect approach is to apply a classification based on a single, minor aspect of the business that is not representative of the overall operations. This ignores the principle of classifying based on the predominant nature of the work and can result in an inaccurate premium. Finally, choosing a classification based on convenience or pressure from the insured, rather than on the factual evidence of operations, constitutes a significant ethical and regulatory failure, undermining the integrity of the auditing process and potentially violating laws requiring accurate premium assessment. Professionals should approach such situations by first understanding the policy contract and the applicable state's classification system. They should then gather comprehensive evidence of the insured's operations through documentation review and, if necessary, on-site inspections. This evidence should be objectively analyzed against the classification descriptions. If ambiguity exists, the auditor should consult internal guidelines, subject matter experts, or the relevant regulatory body for clarification, always prioritizing accuracy and fairness in premium determination. Question 13. Which approach would be most appropriate for a premium auditor when reviewing an insured's financial records that utilize different but generally accepted accounting methods for various aspects of their business to ensure accurate premium calculation? Option A. Choose the accounting method that is easiest for the auditor to understand and process, regardless of its impact on the accuracy of the risk assessment. Option B. Select the accounting method that most consistently and accurately reflects the insured's operational risk exposure over the policy period, in accordance with established accounting principles and policy terms. Option C. Apply the accounting method that the insured's management prefers, without independent verification of its adherence to accounting principles. Option D. Arbitrarily switch between different accounting methods for different revenue streams within the same audit period to capture a broader financial picture. The correct answer is B. Select the accounting method that most consistently and accurately reflects the insured's operational risk exposure over the policy period, in accordance with established accounting principles and policy terms. Explanation: this scenario presents a professional challenge because a premium auditor must ensure that financial information used for premium calculation accurately reflects the insured's operations, adhering to fundamental accounting principles. Misapplication of these principles can lead to inaccurate premium assessments, potentially resulting in undercharging, financial loss for the insurer, or overcharging, unfair burden on the insured. The auditor's judgment is critical in selecting the most appropriate accounting method to ensure fairness and compliance with the policy's terms and applicable regulations. The correct approach involves selecting the accounting method that most accurately and consistently reflects the insured's financial position and operational results over the policy period, as stipulated by generally accepted accounting principles, GAAP, or relevant local accounting standards, and as agreed upon in the insurance contract. This ensures that the premium is based on a true and fair view of the risk exposure. Regulatory frameworks for premium auditing, such as those governing the associate in premium auditing, APAD designation, emphasize accuracy, fairness, and adherence to established accounting standards to maintain the integrity of the insurance process. An incorrect approach would be to arbitrarily choose an accounting method that simplifies the audit process for the auditor, even if it does not accurately represent the insured's operations. This fails to uphold the principle of fairness to the insured and can lead to misrepresentation of the risk. Another incorrect approach is to switch accounting methods mid-audit without a valid business reason or proper disclosure, violating the principle of consistency, which is a cornerstone of reliable financial reporting and premium calculation. Furthermore, relying solely on the insured's preferred method without verifying its adherence to established accounting principles would be a failure, as the auditor's responsibility is to ensure accuracy and compliance, not merely to accept the insured's presentation without scrutiny. Professionals should approach such situations by first understanding the policy's audit clause and any specific accounting requirements. They should then review the insured's financial statements and underlying records, identifying the accounting methods used. A comparative analysis of these methods against established accounting principles and the policy's terms is essential. If multiple acceptable methods exist, the auditor should select the one that provides the most accurate and consistent representation of the risk, documenting the rationale for their choice. Consultation with underwriting or actuarial departments may be necessary if significant discrepancies or complexities arise. Question 14. The analysis reveals that a premium auditor is reviewing a commercial auto policy for a landscaping business. The insured has provided a list of drivers and their ages. The auditor needs to determine the most appropriate driver classification for premium calculation. Which of the following approaches best aligns with the principles of accurate premium auditing and regulatory compliance for this scenario? Option A. Accepting the insured's provided list of drivers and their ages as the sole basis for classification, assuming all drivers are low risk due to their age. Option B. Focusing exclusively on the age of the drivers listed, without investigating their driving experience, accident history, or the specific nature of their vehicle use for the business. Option C. Prioritizing the completion of the audit within a tight deadline by making assumptions about driver classifications based on the business type, without verifying individual driver details. Option D. Reviewing the insured's application, driver's license records, and any available motor vehicle reports to ascertain the primary use of vehicles and the driving history of each listed individual, cross-referencing this with applicable state insurance regulations for driver classification. The correct answer is D. Reviewing the insured's application, driver's license records, and any available motor vehicle reports to ascertain the primary use of vehicles and the driving history of each listed individual, cross-referencing this with applicable state insurance regulations for driver classification. Explanation: this scenario is professionally challenging because accurately classifying drivers is fundamental to correct premium calculation, directly impacting both the insured and the insurer. Misclassification can lead to underpayment of premiums, resulting in financial loss for the insurer and potential coverage gaps for the insured, or overpayment, causing financial strain for the insured. The Associate in Premium Auditing, a PA designation, implies a need for a thorough understanding of regulatory requirements and best practices in driver classification. The correct approach involves a detailed review of all available documentation, including the insured's application, driver records, and any internal company policies, to determine the primary use of the vehicle and the driving history of each individual listed. This aligns with the principles of accurate premium determination as mandated by insurance regulations, which require that all relevant risk factors be considered. Specifically, for the Associate in Premium Auditing, a PA exam, this would involve adhering to the underwriting guidelines and state-specific regulations that dictate how driver classifications are established, ensuring that the classification reflects the actual risk presented by each driver. An incorrect approach that relies solely on the insured's self-reported information without verification fails to meet the auditor's responsibility to ensure accuracy and compliance. This bypasses the essential due diligence required to confirm the risk profile. Another incorrect approach that focuses only on the age of the driver, ignoring other critical factors like driving experience, accident history, and vehicle usage, is a superficial assessment that does not capture the full risk. This violates the principle of comprehensive risk assessment. A third incorrect approach that prioritizes speed of audit over accuracy, making assumptions without substantiation, directly contravenes the ethical and regulatory obligation to conduct a thorough and precise audit. This demonstrates a lack of professional diligence and a disregard for the integrity of the premium calculation process. Professionals should approach driver classification by first understanding the specific regulatory framework governing the jurisdiction of the policy. This involves identifying all permissible criteria for classification and the required documentation to support each classification. A systematic review process, cross-referencing information from multiple sources, is crucial. When discrepancies arise, further investigation and clarification with the insured are necessary, rather than making assumptions. The ultimate goal is to ensure that the classification accurately reflects the risk, thereby upholding the fairness and integrity of the insurance contract. Question 15. The evaluation methodology shows that a small catering business also offers a limited selection of gourmet food items for direct sale in a small retail space within their facility. The insured's primary revenue and operational focus is catering events, which falls under Class Code 8006, caterers. The retail sale of gourmet food items, however, could potentially be classified under Class Code 6305, retail food stores. The auditor must determine the appropriate class code for premium calculation. Option A. Assign Class Code 6305, retail food stores due to the presence of a retail component. Option B. Assign Class Code 8006, caterers, as it represents the primary revenue and operational focus of the business. Option C. Split the premium between Class Code 8006 and Class Code 6305 based on a subjective assessment of the space allocated to each function. Option D. Assign Class Code 8006, caterers, and disregard the retail sales as a minor ancillary activity. The correct answer is B. Assign Class Code 8006, caterers, as it represents the primary revenue and operational focus of the business. Explanation. This scenario is professionally challenging because it requires the premium auditor to exercise significant judgment in classifying a business operation that exhibits characteristics of multiple class codes. The core of the challenge lies in accurately reflecting the primary nature of the insured's business to ensure appropriate premium is charged, adhering to regulatory requirements for premium auditing. Misclassification can lead to underpayment or overpayment of premiums, impacting both the insured and the insurer, and potentially violating regulatory mandates for fair and accurate premium assessment. The correct approach involves a thorough investigation into the insured's operations to determine the predominant source of revenue, or the primary function performed. This requires the auditor to go beyond superficial descriptions and delve into the actual activities, the time spent on each activity, and the revenue generated by each. Regulatory frameworks for premium auditing, such as those governed by state insurance departments in the U.S., mandate that class codes be assigned based on the actual operations of the insured. The 80/20 rule or similar guidelines, often found in state-specific rules or industry standards adopted by regulators, dictate that if a significant portion of the business, e.g., 80%, falls under one classification, that classification should be used. If operations are more evenly split, further analysis is needed to identify the primary exposure or the activity that most defines the business. The ethical obligation is to ensure the premium accurately reflects the risk, which is achieved by correctly identifying the dominant class code. An incorrect approach would be to assign the class code based solely on the insured's stated preference or the most convenient option, without verifying the actual operations. This fails to meet the regulatory requirement for accurate risk assessment and can be seen as a dereliction of duty, potentially leading to adverse selection and unfair pricing. Another incorrect approach is to arbitrarily split the premium between multiple class codes without a clear, documented rationale or adherence to established guidelines for mixed operations. This lacks the analytical rigor required by regulatory standards and can result in an inaccurate premium that does not reflect the true risk profile of the insured. Simply choosing the code that appears most frequently in the insured's documentation without understanding the context of those documents also represents a failure to conduct a proper audit. Professional decision-making process for similar situations should involve a systematic approach. First, understand the insured's business thoroughly through documentation review and interviews. Second, identify all potential class codes that might apply. Third, apply established rules and guidelines, like the 80/20 rule or primary exposure analysis, to determine the dominant class code. Fourth, document all findings, the rationale for the chosen class code, and any supporting evidence. And finally, consult with underwriting or senior audit staff if ambiguity persists. This ensures compliance with regulatory mandates and upholds the ethical responsibility of fair and accurate premium assessment. Question 16. The monitoring system demonstrates that a premium auditor has been assigned to review the operations of a manufacturing company for the purpose of a workers' compensation policy audit. The auditor has received initial documentation from the insured, which includes payroll records and a summary of employee job duties. The auditor is considering how to proceed to ensure the final premium accurately reflects the risk. Which of the following approaches best fulfills the purpose of a premium audit under the applicable U.S. regulatory framework? Option A. Conducting a detailed review of the insured's operational processes, verifying payroll against actual work performed, and applying appropriate classification codes based on the nature of the work and state-specific rules. Option B. Focusing the audit solely on the largest payroll categories, assuming smaller categories are less likely to significantly impact the final premium. Option C. Relying on the insured's verbal assurances regarding the accuracy of their records and the nature of their employees' duties to expedite the audit process. Option D. Reviewing the insured's provided documentation and accepting the employee classifications as presented to finalize the audit. The correct answer is D. Reviewing the insured's provided documentation and accepting the employee classifications as presented to finalize the audit. Explanation. This scenario is professionally challenging because it requires the premium auditor to balance the insurer's need for accurate premium collection with the insured's right to fair treatment and compliance with regulatory requirements. Auditor must ensure that the premium collected accurately reflects the risk exposure as defined by the policy and applicable regulations, while also adhering to the specific reporting and audit procedures mandated by the relevant jurisdiction. The core purpose of premium audits, which is to ensure correct premium, is directly tested here, requiring a nuanced understanding of policy terms, classification codes, and the underlying intent of premium calculation. The correct approach involves a thorough review of the insured's operations and records to accurately classify exposures and determine the final premium. This aligns with the fundamental regulatory requirement that insurance premiums must be commensurate with the risk insured. Specifically, within the U.S. regulatory framework for premium audits, this approach upholds the principle of fairness and accuracy in premium assessment, preventing both underpayment, which can lead to solvency issues for the insurer and potential regulatory scrutiny, and overpayment, which is unfair to the insured and can violate state insurance laws regarding excessive premiums. Adherence to established auditing standards and guidelines, such as those promoted by the NAIC or individual state departments of insurance, is paramount. An incorrect approach that focuses solely on the insured's stated figures without independent verification fails to fulfill the auditor's responsibility to ensure accuracy. This can lead to misclassification of exposures, resulting in an inaccurate premium. Such a failure violates the regulatory expectation that audits are a mechanism for verifying reported information and ensuring compliance with policy terms and rating rules. Another incorrect approach that prioritizes expediency over thoroughness, such as accepting a limited sample of records without understanding the full scope of operations, also falls short. This can result in overlooking significant exposures or misinterpretations of operational activities, leading to an inaccurate premium. This approach neglects the regulatory imperative for a comprehensive and accurate assessment of risk. Finally, an approach that applies classifications or rules inconsistently or in a manner not supported by the policy or regulatory guidelines is also professionally unacceptable. This can lead to arbitrary premium adjustments that are not grounded in the established rating structure, potentially resulting in unfair discrimination or violation of rate filing requirements. The professional decision-making process for similar situations should involve a systematic approach. First, understanding the policy's terms and conditions and the applicable state's insurance regulations. Second, planning the audit to cover all relevant aspects of the insured's operations. Third, gathering and verifying all necessary documentation. Fourth, applying the correct classification codes and rating rules based on the verified information. And fifth, documenting the audit process and findings clearly and comprehensively. This ensures that the audit serves its intended purpose of accurate premium determination and regulatory compliance. Question 17. Operational review demonstrates that a client's business operations have evolved significantly over the past audit period, leading to activities that fall under a different, higher premium classification than what was initially declared. The client, a small business owner, expresses surprise and suggests that their previous auditor never raised this issue and that they have always operated this way. The premium auditor has gathered clear evidence supporting the change in classification. Option A. Accept the client's stated classification, assuming the previous auditor's oversight was correct, and close the audit without further action to maintain a positive client relationship. Option B. Reclassify the business operations to the correct, higher premium classification based on the audit evidence, clearly communicate the findings and the rationale to the client, and provide them with an opportunity to discuss the findings and provide any additional relevant information. Option C. Advise the client that the discrepancy is minor and can be overlooked to avoid administrative burden and potential client dissatisfaction. Option D. Immediately issue a revised premium assessment with penalties, citing the incorrect classification, without further discussion with the client. The correct answer is B. Reclassify the business operations to the correct, higher premium classification based on the audit evidence, clearly communicate the findings and the rationale to the client, and provide them with an opportunity to discuss the findings and provide any additional relevant information. Explanation. This scenario presents a professional challenge because it requires the premium auditor to balance the need for accurate premium calculation with the potential for strained client relationships. The auditor must uphold regulatory compliance and ethical standards while navigating a situation where the client's actions, even if unintentional, have led to an incorrect classification that benefits them financially. Careful judgment is required to ensure that the audit process is thorough, fair, and adheres to all applicable regulations without alienating the client unnecessarily. The correct approach involves meticulously documenting the findings, clearly communicating the discrepancy to the client with supporting evidence, and proposing the correct classification based on the audit evidence and relevant regulatory guidelines. This upholds the auditor's professional responsibility to ensure accurate premium assessment, which is fundamental to the integrity of the insurance system and compliance with regulatory frameworks governing premium audits. Adhering to established classification rules and providing clear, evidence-based explanations ensures fairness and transparency. An incorrect approach of accepting the client's stated classification without further investigation fails to meet the auditor's duty of care and regulatory obligations. This could lead to underpayment of premiums, which is a violation of insurance regulations and potentially constitutes fraud if done knowingly. Another incorrect approach of immediately imposing penalties without a clear explanation or opportunity for the client to rectify the situation can damage the professional relationship and may not be in line with the spirit of regulatory guidance, which often emphasizes correction and education. Finally, an approach that involves overlooking the discrepancy to maintain a good client relationship compromises the auditor's professional integrity and the accuracy of the audit, potentially exposing the insurer to financial risk and violating regulatory mandates for accurate premium collection. Professionals should employ a decision-making framework that prioritizes adherence to regulatory requirements and ethical principles. This involves a systematic process of evidence gathering, analysis against established guidelines, clear and objective communication with the client, and a commitment to fair and accurate outcomes. When discrepancies are found, the process should include an opportunity for the client to understand the issue and provide further information, followed by a reasoned decision based on the evidence and regulations. Question 18. The risk matrix shows that Auto Parts Plus has listed its primary operation as retail sale of auto parts. However, the audit documentation indicates that the business also performs minor vehicle repair services, such as oil changes and tire rotations, for customers who purchase parts. The auditor must determine the correct classification for the repair services. Option A. Classify the entire business as a garage operation based solely on the presence of any repair activity, without further analysis of its significance. Option B. Classify the repair services as incidental to the primary operation of auto parts retail, provided they are minor in scope and do not represent a significant portion of revenue or operational focus. Option C. Classify the repair services as a primary garage operation, regardless of their limited scope, due to the performance of any vehicle repair work. Option D. Exclude the repair services entirely from the audit, assuming they are not a core business function and therefore not relevant to the premium calculation. The correct answer is B. Classify the repair services as incidental to the primary operation of auto parts retail, provided they are minor in scope and do not represent a significant portion of revenue or operational focus. Explanation. This scenario is professionally challenging because it requires a premium auditor to navigate the nuances of garage operations coverage, specifically distinguishing between incidental and primary operations, while adhering strictly to the associate in premium auditing, APA, exam's regulatory framework. The auditor must apply judgment based on the provided information to accurately classify the risk and ensure appropriate premium is charged, preventing underinsurance or overinsurance. The core of the challenge lies in interpreting the scope of services offered by the insured and aligning it with the classification rules. The correct approach involves a thorough review of all provided documentation, including the insured's application, financial records, and any supplemental information detailing the services offered. This approach is correct because it aligns with the fundamental principles of premium auditing, which mandate a comprehensive and accurate assessment of the insured's operations. Specifically, it requires the auditor to determine if the vehicle repair services are incidental to the primary business of selling auto parts, or if they constitute a significant primary operation. Regulatory guidance for premium auditing emphasizes the importance of classifying operations correctly to ensure fair and accurate premium calculation, preventing adverse selection, and maintaining the integrity of the insurance contract. This method ensures that the premium reflects the actual risk exposure. An incorrect approach would be to solely rely on the insured's initial classification without further investigation. This is ethically and regulatorily flawed because it abdicates the auditor's responsibility to verify the accuracy of the classification. It risks misrepresenting the insured's operations, potentially leading to an incorrect premium. Another incorrect approach would be to assume that any repair work performed automatically triggers a higher risk classification, irrespective of its volume or significance relative to the primary business. This lacks the necessary analytical rigor and fails to differentiate between incidental and primary operations as defined by underwriting guidelines and regulatory expectations for premium auditing. Such an assumption could lead to an unfairly inflated premium. Professional decision-making in similar situations requires a systematic process. First, understand the insured's business and the services they offer. Second, consult the relevant classification codes and their definitions, paying close attention to exclusions and conditions for incidental operations. Third, gather all necessary documentation to support the classification. Fourth, apply professional judgment based on the evidence, adhering to regulatory requirements and ethical standards. Finally, clearly document the rationale for the chosen classification. Question 19. Consider a scenario where a business is headquartered in Texas, but has a significant number of employees who primarily perform their duties in New Mexico. The insured provides the premium auditor with a list of employee classifications based on their understanding of general industry practices. The auditor must determine the correct workers' compensation classification for these employees. Which approach best ensures compliance with state-specific regulations? Option A. Apply the employee classifications based on the state where the business is headquartered, Texas, as this is the primary location of the insured entity. Option B. Research and apply the specific workers' compensation classification rules and codes mandated by the state of New Mexico, as this is where the majority of the employees perform their work. Option C. Apply the employee classifications provided by the insured, assuming their understanding of general industry practices is accurate and sufficient for premium calculation. Option D. Utilize a generic national classification standard that is commonly applied across various states for similar occupations, as this provides a consistent approach. Correct answer is C. Apply the employee classifications provided by the insured, assuming their understanding of general industry practices is accurate and sufficient for premium calculation. Explanation. This scenario is professionally challenging because it requires a premium auditor to navigate conflicting state-specific regulations regarding the classification of employees for workers' compensation purposes. The auditor must understand that each state has its own unique set of rules, definitions, and exceptions, and failing to adhere to the correct state's framework can lead to significant financial and legal repercussions for both the insured and the insurance carrier. The core of the challenge lies in accurately interpreting and applying these distinct state laws to the insured's operations, ensuring compliance and proper premium calculation. The correct approach involves meticulously researching and applying the specific workers' compensation classification rules of the state where the insured's employees primarily perform their duties. This approach is right because it directly addresses the jurisdictional requirement of workers' compensation insurance. Regulatory frameworks, such as those established by state departments of insurance and workers' compensation boards, mandate that coverage and classification must align with the laws of the state where the risk is located. For instance, if an employee works primarily in California, California's specific classification codes and rules for that occupation must be applied, regardless of where the business is headquartered or where other employees might occasionally work. This ensures that the premium accurately reflects the risk profile as defined by the governing state statutes and regulations. An incorrect approach that relies solely on the insured's stated classification without verifying against the governing state's regulations is professionally unacceptable. This fails to meet the auditor's fundamental responsibility to ensure compliance with applicable laws. It could lead to underpayment of premiums, resulting in potential audit penalties, back premiums, and legal liabilities for the insured. Furthermore, it exposes the insurance carrier to inadequate reserves and potential claims disputes. Another incorrect approach, which is to apply a generic national standard for classification, is also flawed. While some national industry standards might exist for general business practices, workers' compensation is inherently state-specific. Relying on a non-jurisdictionally compliant standard ignores the legal mandates of the state where the employees are working, creating the same compliance and financial risks as the first incorrect approach. A professional decision-making process for similar situations should begin with identifying the primary state of operation for the insured's employees. This is followed by a thorough review of that specific state's workers' compensation laws, classification codes, and any relevant administrative rulings or guidelines. The auditor must then apply these state-specific rules to the insured's operations, documenting the rationale for each classification decision. If there are ambiguities or conflicts, the auditor should consult with the underwriting department and potentially legal counsel to ensure accurate and compliant application of the law. Question 20. The assessment process reveals that a business insured under a commercial property policy has described its primary operational asset as specialized manufacturing equipment. However, the policy's classification schedule uses distinct categories for heavy industrial machinery and light assembly equipment, with differing premium rates. The auditor must determine the correct classification for this asset. Option A. Classify the asset as light assembly equipment because the insured's description is not explicitly heavy industrial machinery. Option B. Classify the asset as heavy industrial machinery if its operational noise level exceeds 80 decibels, as this is a common indicator of such equipment. Option C. Seek detailed specifications and operational descriptions from the insured, cross-reference these with the policy's definitions for heavy industrial machinery and light assembly equipment, and consult the insurer's underwriting guidelines to determine the most accurate classification. Option D. Classify the asset based on the perceived complexity of its operation, assuming more complex operations align with heavy industrial machinery. The correct answer is B. Classify the asset as heavy industrial machinery if its operational noise level exceeds 80 decibels, as this is a common indicator of such equipment. Explanation: the assessment process reveals a common challenge in premium auditing, accurately classifying property for insurance purposes when the insured's description is ambiguous. This scenario is professionally challenging because the auditor must apply specific regulatory definitions and underwriting guidelines to a real-world situation, ensuring both compliance and fairness to the insured. Misclassification can lead to incorrect premium calculations, potentially resulting in underpayment, exposing the insurer to risk or overpayment, unfairly burdening the insured. Careful judgment is required to interpret the insured's information within the established framework. The correct approach involves a thorough review of the insured's provided documentation, cross-referencing it with the policy's definitions and the insurer's underwriting guidelines for property classification. This approach is correct because it adheres to the principle of accurate risk assessment, which is fundamental to insurance. Specifically, it aligns with the regulatory expectation that premiums accurately reflect the risk insured. By seeking clarification and applying established definitions, the auditor ensures the property is classified according to its intended use and characteristics as defined by the policy and relevant regulations, thereby upholding the integrity of the premium calculation. An incorrect approach would be to make an assumption based on the most common use of such property, without verifying with the insured or consulting policy definitions. This fails to meet the regulatory requirement for precise risk assessment and can lead to misrepresentation of the risk. Another incorrect approach would be to simply accept the insured's self-classification without any independent verification or application of policy terms, which bypasses the auditor's responsibility to ensure accurate classification according to the policy contract and regulatory standards. A third incorrect approach would be to classify the property based on a personal understanding of similar items, rather than the specific definitions and guidelines provided by the insurer and mandated by regulatory frameworks governing premium auditing. This introduces subjective bias and deviates from the objective application of rules. Professionals should approach such situations by first understanding the policy's definitions and the insurer's underwriting rules. They should then gather all available information from the insured, seeking clarification on any ambiguities. If necessary, they should consult with underwriting or claims departments for guidance. The decision-making process should prioritize adherence to the policy contract and regulatory requirements, ensuring that the premium accurately reflects the risk presented.